So, whole life insurance is a scam. That's what everyone says anyway. And look, I get the criticism isn't totally wrong, but there's a lot of bad products out there with high fees, terrible sales tactics, and let's be honest, most people who sell this stuff don't really understand how it works, so they pitch it wrong. But here's what's interesting, the wealthy keep buying it. They're not stupid, so what did they see that everyone else is missing? The thing is, there are three power moves that the wealthy use with whole life insurance that the critics completely ignore. And I'm going to show you exactly how they do it. Because when you understand these strategies, you'll see why dismissing whole life entirely is actually leaving money on the table. Now, I'm not saying this is for everyone, it's definitely not. But for people in specific situations, these strategies can become incredibly powerful. So let's dive into what the wealthy actually do with whole life insurance and why they keep using it despite all the criticism. The first power move is using whole life as a tax-free wealth engine, and here's how it works. When you pay premiums into a properly structured dividend-paying whole life policy, the cash value grows without being taxed. Currently, that means every dollar of growth compounds tax-free year after year. And this isn't like a 401k where you'll pay taxes later. This is tax-free growth that you can access tax-free through policy loans. Now, here's where it gets interesting. You can borrow against your cash value at any time for any reason. And the insurance company doesn't care what you're using the money for. You're essentially borrowing against your own money. And the best part is your cash value keeps growing even while you have a loan against it. So you're using the money while you're still earning dividends. This creates a powerful leverage strategy during your wealth building years. Let's say you want to buy a rental property. Instead of going to the bank and jumping through hoops for a mortgage, you can borrow from your policy at a fixed rate, normally around 4 to 6%. And here's the kicker. Your cash value might be earning 5 to 7% in dividends, so you're potentially making money on the spread. Compare this to traditional financing where you're dealing with credit checks, income verification, and all that hassle with your policy. You can have the money in days, not weeks. And there's no monthly payment requirement. You can pay it back on your own schedule or not at all. The insurance company doesn't care because they have your cash value as collateral. Now, critics always bring up opportunity costs. They say that you could make more money in the stock market, and sure, maybe you could, but here's what they're missing. Liquidity matters more than maximum returns for certain goals. If you need access to capital quickly for opportunities, the stock market might be down when you need the money, but your cash value is always there. Plus, you get a death benefit the whole time. So you're building wealth while also protecting your family if something happens to you. It's like having the cake and eating it too. You're building wealth, accessing it, and when you need it, and providing protection at the same time. The key is setting this up properly as a dividend-paying whole life policy with emphasis on cash value growth. A dividend-paying mutual company because these dividends help your cash continue to grow over time. Instead of being fixed, this isn't about insurance. This is about creating a financial tool that gives you flexibility and options. And here's something important. This doesn't replace your 401k or stock investments. It works alongside them. You still need your traditional growth investments, but this gives you a liquid, stable bucket that complements your portfolio. The second power move is something most people never even think about. It's using whole life as a volatility buffer in retirement. And this is where things get really interesting because this strategy can literally save your retirement from market crashes. Here's the problem with traditional retirement planning. When you're in your accumulation years, market volatility doesn't hurt you that much because you're buying more shares when prices are low. But once you start withdrawing the money in retirement, market timing becomes everything, and this is called the sequence of returns risk. Let me explain what happens when the market crashes right when you retire. Let's say you got $1 million in your 401k and you need to withdraw $50,000 a year to live on. If the market drops 30% in year one, you're not just down $300,000, you're also pulling out $50,000 from a smaller pot. So now you've got $650,000 left instead of $950,000. And here's the killer part. If the market recovers, you don't have as much money participating in that recovery because you had to sell at the bottom. This is how market crashes destroy retirement plans. Even if the market eventually recovers, you never fully recover because you locked in those losses by withdrawing during a downturn. And this happened to a lot of people in 2008 and again in 2020. They had to sell their investments at the worst possible time just to pay their bills. So here's where the volatility buffer comes in. Instead of withdrawing your crashed 401k, you borrow from your whole life policy during market downturns. Your cash value doesn't go down with the market. It keeps growing steadily through dividends. So you can access that money while your retirement accounts recover. Think of it like this. You got two buckets. One bucket is your growth investments, like stocks and a 401k that can go up and down. And the other bucket is your whole life policy that provides steady, predictable access to cash. When the stock bucket is down, you draw from the life insurance bucket. When the stock bucket is up, you can pay back the policy loan or just let your cash value keep growing. This strategy gives you a bond-like stability, but with way better liquidity than actual bonds. If you own bonds and you need money, you have to sell them at whatever price they're trading at. But with whole life, you can borrow against your cash value regardless of what's happening in the markets. Let me walk you through how this would have worked in 2008. Let's say you retired right before the crash with $500,000 in stocks and $200,000 in whole life insurance cash value. Instead of selling your crash stocks, you borrow $50,000 a year from your policy for 3 years while the market recovers. By 2011, your stock portfolio is back to $500,000 and you only borrowed $150,000 from your policy, which you can either pay back or not. Compare that to someone who had to withdraw from their 401k during the crash. They would have permanently lost that money and never fully participated in the recovery. This is why wealthy retirees use this strategy. It's not about getting the highest returns. It's about making sure you never have to sell investments at the worst possible time. Now, this doesn't replace your other retirement accounts. It works alongside them. You still want growth investments for long term, but you also want this stable bucket that you can tap into when markets are volatile. It's part of what financial planners call the bucket strategy, where you can have different buckets for different purposes and time horizons. And remember, this only works with properly structured dividend-paying whole life insurance policies that emphasize cash value growth, not the typical whole life policies that most agents sell. The third power move is asset protection, and this is huge for people with significant wealth. In most states, whole life insurance cash value is considered an exempt asset, which means creditors can't touch it. Even if you're getting sued and lose everything, your life insurance cash value is protected. This is incredibly valuable for business owners, professionals, or anyone who might face a lawsuit risk. Your real estate investments, your business, your brokerage accounts, all of those can be seized in a judgment, but your whole life cash value is off limits. This gives you a place to park money that's completely protected from creditors and legal judgments. But it gets even better. Whole life policies often come with accelerated death benefit riders, which means if you need long-term care, you can access your death benefit while you're still alive. This is like having long-term care insurance built into your policy. It's way more flexible than traditional long-term care policies. Traditional long-term care insurance has all kinds of restrictions on what qualifies, when you can use it, and how much they'll pay. But with whole life insurance, if you meet the criteria for needing care, you can access the death benefit to pay for it. And if you never need care, your beneficiaries still get the whole death benefit. Plus, you can always use your cash value to pay for care without touching your other investments. This means your retirement accounts can grow while your life insurance handles the care costs. It's like having a dedicated bucket of money just for healthcare emergencies. For high net worth individuals, this also provides estate planning benefits. The death benefit can help equalize inheritances among children and provide liquidity to pay for estate taxes without having to sell family businesses or real estate. Look, I'm not going to pretend that whole life doesn't have legitimate criticisms. The fees are higher than term insurance and the returns aren't going to beat a good stock portfolio over the long run. But here's the thing, it's not supposed to replace your growth investments. It's supposed to complement them. Whole life insurance is not a replacement for your 401k or investing in stocks. It's meant to be used alongside traditional investing as part of a diversified strategy. This strategy works best for people with higher incomes who have maxed out all their other tax-advantaged accounts and have a longer time horizon to let cash value build up. If you're just getting started with investing or you're living paycheck to paycheck, this probably isn't for you to focus on. Max out your 401k and build a stock portfolio first. The key is to actually understand how to structure these policies properly, as dividend paying whole life with emphasis on cash value growth, because there are a lot of bad products and bad advisors out there who sell you a traditional whole life policy that don't work for these strategies. But when done right by people who understand whole life isn't a scam, it's a sophisticated financial tool that provides a liquidity, asset protection, and tax advantages that you can't get anywhere else. And it works best when used alongside, not instead of your traditional investments.